Welcome to the WTR Small Cap Spotlight podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I'm joined by Neal, President and CEO, and Lyle Williams, Executive Vice President and CFO of Forum Energy Technologies, NYSE ticker symbol FET. FET is a global manufacturer of value-added solutions that enable customers to maximize the efficiency and safety of developing their hydrocarbon assets. The company's downhole and completion segment contributes about 60% of revenue, and the artificial lift and downhole segment contributes approximately 40%. Revenue is equally split between the U.S. and international markets. FET's customers include the E&P operators who own the hydrocarbon assets and oil field service companies who work with the asset owners to extract the resources. Also joining us is my WTR equity research colleague, Jeff Robertson. Good morning, gentlemen, and thank you for joining today's podcast.
Good morning.
Thanks, Tim.
Thanks, Tim.
So, gents, to kick things off, FET's share price turned in exceptional performance in 2025, so congratulations on that. Neal, how does the company's capital allocation philosophy support FET's ability to gain share in the markets it competes in while also improving the balance sheet and returning cash to shareholders?
Yeah. Well, Tim, great to meet you, and again, thanks for having us on your podcast. So our capital return framework has been in place for a while now, and I think it's very straightforward. We use 50% of our free cash flow to further reduce net debt, and the remaining 50% is allocated to strategic investments, which include acquisitions and returning cash to shareholders. I think the policy has yielded some very successful results. For example, our net leverage ratio now is about 1.3 times, which is very appropriate for our business and industry. And through October of 2025, we have repurchased nearly 9% of the shares that were outstanding at the beginning of 2025. Importantly, with this policy, though, we've been able to accomplish these returns while also gaining market share. And this is because of our capital light business model. We need very little CapEx to grow our revenue, and we have significant operating leverage. So, I think as we've shown over the past few years, FET is a cash flow generating machine.
Very impressive. I appreciate that overview, Neal, and I'll turn it over to Jeff to ask a few questions.
Thanks, Tim. Neal, you recently outlined an FET 2030 strategy that's built upon the continued execution of your beat the market strategy. How will FET's business lines help the company achieve its goals in what's a volatile commodity price environment?
Right. The goal of our beat the market strategy is, I think, very simple. We want to grow faster than the market through profitable share gains. It's a strategy that's been very successful, and we've executed well. Since we implemented it in 2022, we have increased our market share by 20%, as measured by revenue per rig. I think the strategy begins by carefully choosing where we want to compete, right? We only want to compete in markets where we can win. These are targeted markets with few competitors and where our customers value the differentiated products and solutions we deliver. Second, we seek to utilize our competitive advantages. So this is our in-house manufacturing know-how, our intellectual property, our recognized brands, which in some cases have been around many decades, and our people who are really experts in the areas where we compete. We combine that with continuous innovation. This allows us to further separate from our competition and keep new entrants out of our markets and expand the markets that we address. And then finally, with this strategy, we are leveraging our global footprint. So this lets us quickly respond to customer demand around the world while maintaining an efficient and resilient supply chain. Putting it all together, we believe this strategy will help us grow revenue and EBITDA in a volatile commodity price environment.
You've talked about differentiation between leadership markets and growth markets. Can you characterize what you consider in both of those areas?
Yeah, when we looked at our our portfolio as we came into this year. We've had the beat the market strategy for a while, and we wanted to refine that a little bit. And so we really separated our revenue into really two big buckets. One being our leadership markets, and the other being our growth markets. Within our leadership markets, we have strong share, about 36% share in aggregate. Our solutions have been well accepted by the industry. Again, they are differentiated markets, and we think we have a good opportunity for some growth, but we have a meaningful share already. Our growth markets, however, have similar characteristics to our leadership, but they're in the earlier stages of industry adoption. So we may have fewer customers, or we may be more limited on geography. So our opportunity here is to grow our share from, let's say, around 8% to 16%. And that's our 20 part of our FET 2030 goal, is to double that share. Also, those growth markets that we've identified are about twice the size of our leadership market. So I think the opportunity is immense, and we're excited about what we have ahead.
You touched earlier on competing in markets where you can win. Can you elaborate on the primary drivers behind FET's competitive position that allow you to maintain and grow market share in those product lines?
Yeah, I think we've carefully identified the markets where we compete. We're not going to be everything to everybody. We want to be again in markets where customers value our products, where again we have that differentiation. Again, it could be manufacturing know-how or IP or experts. I think if you just take a few examples, in coiled tubing, where we are one of three global manufacturers of quench and tempered coiled tubing. So again, limited competition serving the globe. Another example is our greaseless wireline cables. We are one of three manufacturers that make high pressure greaseless cables for hydraulic fracturing applications. So again, we have very few competitors, and we have targeted these markets. So we know what it takes to win. And then I think maybe the last part is we have the people in place. Over the years, we've built our commercial and technical teams from people who have strong but very detailed industry experience. So many times we actually hire employees that used to work with our customers, and so they understand how our products are used and how we can optimize our innovation again to continue to differentiate ourselves.
If we think about coiled tubing and some of the greaseless wireline products, are those opportunities for FET in both your leadership markets and in growth markets?
Yeah, I think that's a great point. Obviously greaseless cable and coiled tubing, we have strong market share, but what we're finding is we're able to develop new products that have application, let's say, outside our home market. Great example is the adoption of unconventional technology outside of the US. So this is in Latin America and the Middle East. For example, our greaseless cable, this is a workhorse of North American shale. This year, we've shipped our first two cables outside the US. When I say this year, I meant 2025. It's hard to believe we're in 26, but in 2025, we've shipped our first cables outside the US and into Latin America and into the Middle East as well. So I think that is part of our growth opportunity, even in our leadership markets.
Neal, do you see those types of products for unconventional resource around the globe as being adopted on a quicker cycle because they've essentially been proven in the North American shale plays for the last decade or so?
Yeah, that's a great point. As I think back on our company and on my career, we were making version A 20 years ago for shale gas, and we've continued to adopt and innovate. We're on version Z or even further. What we're finding is our opportunities internationally is they're not beginning at A. They're starting at the latest and greatest. And so that's a great opportunity for us to, again, generally our newest products have higher margins, so we're shipping those products, but we're giving them the same type of productivity that we helped our customers in the US gain.
You mentioned early on the capital light nature of your manufacturing business. Is that such that you can supply a lot of those markets from your U.S. asset base?
Absolutely. With our the footprint we have in place, and as we looked at, our ability to grow, we believe we can increase our revenue 50% without really investing in any growth CapEx. And even at that point, we're talking about maybe adding shifts or adding machine tools to expand it even further. So, or in worst case, leasing some more space to grow. So I think we have the footprint. What we need is the demand, and so that's where our teams are focused on, again, understanding the opportunity and getting out there. One example that I like to talk about, when we think about the international opportunity is on our pump protection tools. In the U.S., we've had gained significant share by providing a product that allows our customer who are oil and gas operators to extend the life of their downhole pump. So the value prop is simple. You buy our tools, which aren't very expensive, and you're going to extend the life of your pump, so you're going to get more oil at a lower cost. Internationally, they have the same application possible, except they're choosing not to protect their pumps. And even more exciting is that market is about 4 times larger than what we're participating in the US. So if we can take that success and that share that we've achieved in the US and export it internationally, we have a significant opportunity for growth.
I would think if you have lower oil prices that persist for a little while, the investment in an inexpensive product to extend the life of the relatively much more expensive pump becomes a pretty attractive trade-off.
I agree with you 100%, Jeff. And that, we sometimes say our main competitor is status quo, right? We have to help our engineering clients, engineering customers, and the engineers at the oil companies understand why they really should take the opportunity. So it's where we put our time, it's where we put our resources, where we put our efforts. Again, having that footprint. Again, we have manufacturing in Saudi already. We have, we've been in the UAE for many, many years now. So by having these positions, we're able to, again, take the success we've had in the US and utilize that footprint to address new markets.
You talked about the 2030 vision. And I think you mentioned doubling revenue over the next 5 years or so. Can you put some parameters around what that could mean for adjusted EBITDA if margins stay somewhat consistent with where they are today?
Yeah, as we think about kind of 2030, we've really put it kind of on two brackets. One is if markets stay flat and we don't grow, we think we can grow. We think we can grow our revenue by 30% by implementing our beat the market strategy. Again, that would lift our overall revenue to about $1 billion. Again, that's just taking advantage of the growth markets. But I think as maybe we believe, and I think you do as well, as we look at the global drivers for economic growth, for urbanization, that's going to push oil and gas demand. And with that demand push, as an industry, we're going to have to provide that additional supply while overcoming significant decline rates. As we look ahead, we think about 2030, just thinking about oil. If the market grows a little bit, let's call it 6 million barrels a day from 105 million barrels a day. That's about 6 million barrels of growth per day. We're going to have to overcome 29 million barrels a day of decline rate. So that's the huge challenge for our industry. So overcoming that decline, supplying that demand, we think the markets that we participate in have the opportunity over that time frame to grow about 9% a year. And in that scenario, we see our revenue doubling to about 1.6 billion. And with our capital light business structure, we think, let's call it 25 to 35% of the additional revenue will turn into EBITDA, and 60 to 70% of that EBITDA will turn into free cash flow. So doubling our revenue, quadrupling of EBITDA, and tripling our free cash flow from where we are today. That's where we see FET 2030, and that's what's so exciting for us.
Lyle, the FET 2030 that Neal lays out presents some interesting opportunities for the person wearing the CFO hat.
It sure does. Really exciting. A lot of cash that we'll get to count.
FET's latest free cash flow outlook for 2025 is $70 to $80 million, which was compared to an original free cash flow outlook provided in February of 2025 of $40 to $60 million. A lot's changed since the early outlook came out with tariffs and weakening oil prices. I know fourth quarter 2025 numbers won't be posted until the second half of February, but Lyle, can you just recap for us how the company navigated 2025 through September, October type period to increase free cash flow in a falling oil price environment?
Absolutely, Jeff. And you're right. I think the key point to measure is the first and foremost, the forecast that we've had on free cash flow. So our teams have done a great job of managing and looking at free cash flow, really starting back a couple of years. It's been a big change in focus for the team. In about April of this year, we had two things happen. OPEC announced incremental oil production. We had introduction of tariffs that caused everyone to be afraid of dropping demand. So put those two together, there was a big move in the industry and a downward revision and outlook for activity. So our teams really began to focus on two things. One of those being cost reduction, and the other one being on incremental cash flow generation. That was the big change for the year, and what have we been able to achieve really through September to get that guidance up that we've done. With a lower activity, we reduced our receivables from customers and our inventory balances, generating meaningful incremental free cash flow above our original plan. And then we added to that $15 million from two real estate sale leaseback transactions. Those are one-off kinds of deals, not something we would look at going forward, but definitely added to this year's cash flow. And then in addition to leveraging our assets, we set a goal to improve our cost structure. On last quarter's earnings call, Jeff, I think we talked about this, but we shared that we have already achieved $10 million of run rate cash savings from those cost savings efforts, and we announced facility consolidations that are going to yield an additional $5 million in cost savings beginning in 26 through reduced overhead, better use of our direct labor and assets, and more efficiency in our operations. So total structural cost savings now look like about 15 million that would say we have in place and will be achieved by next year. So putting all that together, despite the macro challenges we talked about, we increased our full year cash flow guidance by 50% from what we originally talked about, while building a tailwind for EBITDA for 2026. And if you look back really over the last 9 quarters or so, assuming we hit that midpoint of that guidance, we'll be talking $200 million of cash flow over that period of time. That's a significant amount of cash given our size. We're super proud of what our teams have done in this area and look forward to how we can continue that going forward.
Do you have any high-level thoughts at this point on 2026 in terms of activity levels, and do you think the industry has settled on the glide path it was on as it closed out 2025?
Gosh, earlier you asked a question about volatility in the industry, and I definitely think that that's something we need to watch for. We're about a month out from our 2026 earnings call, and there we'll give more formal guidance. But as we sit today, Jeff, there's a lot of market concerns about surplus global oil supply. And depending on who we talk to in our customer base, it's either more or less in terms of what their concerns are. What we're starting to settle on is we believe that 2026 in average is going to be slightly softer than 2025 on a full year average. But if you look at second half of 25 was softer than first half. So really what we're thinking today is that 2026 probably be relatively flat with 2025 as far as activity outlook. Obviously, big caveats about what happens with commodity prices and where those end. For us, when we're starting to put together our view of FET for 2026, we've got a strong backlog from orders that we received in 2025. Neal's talked a lot about our planned market share gains, and we expect those to continue in 2026, and the structural cost savings efforts that we put forward. When we put all that together, we're actually looking forward to 2026. And more importantly than just kicking off 2026, staying focused on the long-term vision, beating the market, taking market share over the long term, and seeing what that can do for the company.
Acquisitions have played an important role in FET's growth over the years. When you think about the 2030 vision, what role do acquisitions play in those goals? And are there certain product lines or certain acquisition opportunities that could help leverage FET's existing product lines to further gain market share?
No, great question, Jeff. Thanks. And indeed, acquisitions really have played an important role in our growth, both over the long haul, but also more recently. For example, at the outset of 2024, we completed the acquisition of Variperm. That's a leading provider of specialty downhole tools to the Canadian oil sands market. We completed the deal on really favorable terms while roughly doubling FET's EBITDA and free cash flow. It's been a terrific acquisition, and the performance of the Variperm team has just been terrific. As we look ahead, I think first, the FET 2030 growth goals that we have are fully organic. We don't have any M&A in those. However, as Neal mentioned, tripling our free cash flow means that we're going to have a lot of dry powder for acquisitions. So we'll be thinking about what we can do there really in a couple ways. First, looking at criteria. We want to make sure we focus on acquisitions that have differentiated technology and are in targeted niche markets, so they fit our strategy. We want to make sure that those deals are going to be accretive to our current financial metrics and protect our balance sheet. So once we find deals that fit into those areas, we can weigh them against other uses of capital. For example, buying back shares. Midpoint of our free cash flow guidance this year puts our free cash flow yield at 17%. That's a really attractive investment for our capital. We would look to compare any deal we look at with that 17% metric. There are lots of opportunities for us to look at, and when we think about areas of focus, I think important for us, Jeff, and you know this, but we have a very broad product offering. So that presents many opportunities to look, gives us a chance to really look at exciting underlying technologies that add to our portfolio and meet our acquisition criteria. So I think broadly, we don't have acquisitions in our plan, but we're going to have a lot of capital to deploy. We'll look at good deals, good technology that meet our criteria and are supportive of our long-range strategy.
Just want to touch on the headlines of the last week or so briefly with everything going on in Venezuela and the potential to re-engage in the oil markets down there. But I know you all are, with respect to FET's product lines, are there certain products that have a lot of application in Venezuela's producing oil and gas reserves?
Yeah, Jeff, I mean, we haven't been selling into Venezuela now for many years. And, I think back to the last time I was in that country, I think in 2007 or so, the country, even then the country still needed a lot of investment in its industry. So I think there's a lot of areas where Western companies could put a lot of capital in there and help get production up. But I think about the potential they have, that Lyle mentioned our Variperm acquisition, they have that sand and inflow control products. So those are used in heavy oil in Canada. That could be an application for us in Venezuela as well. Also thinking about the other capital equipment and infrastructure products that we have, like our drilling capital products, like our FR120, our workover equipment from Hawker, coil line pipe. In fact, that I think there's been a lot of line pipe used in the country over the years, and our multi-lift, product line. So I think we have a number of areas that we could address. I think it's getting the certainty. I think just like the Western oil companies are saying, right, you need to have the contractual certainty, security certainty, obviously legal certainty if we were to go into Venezuela or sell into Venezuela. But I think maybe we have a lot less risk than an oil company, right? We'll put our products on a boat, and as long as we get paid, we're okay. So that's where we'll focus on risk mitigation is making sure that if we do sell into the country, we're going to receive cash for the goods we supply.
Since you mentioned the FR120, I thought it was interesting that you have a new advertising channel with the cameo appearance it had in Landman a couple of episodes back.
It was a fantastic experience, and what I really love the most about it, Jeff, is how well our sales teams got. So the Landman production crew found our FR120 through the web, through our website, contacted us, and our team treated it like a potential sale, and it went through our CRM system, and we were able to respond really quickly. I think with that response they decided to make us what they call the hero vendor in the show, and so for those who saw the show, we were shown as a way to make oil and gas production safer, more efficient, and increase productivity. So that was great to see, and it was a really fun event. Nice. The actors there were also fantastic, and so I have nothing but great things to say about our experience with Landman and that production crew.
I want to be respectful of everybody's time. So, Neal, if we could just wrap up, are there certain opportunities, or can you highlight the best opportunities that you see that'll be instrumental to FET executing the Vision 2030 strategy?
Yeah, I mean it really goes back to the execution, right? It's our beat the market strategy. It's making sure we're competing in the targeted markets where we can win. It's utilizing our competitive advantages. It's innovation, and it's our global footprint. So I look at our growth markets. Those are the ones that we're going to have the most juice for growth, right? Where there's going to be adoption of solutions that have been incredibly successful in one market, export that success to other markets. And if we achieve that, I think we'll be well on our way to achieving FET 2030, which again, doubling revenue, quadrupling EBITDA, tripling cash flow in the next 5 years. Again, exciting opportunity for FET's employees and our investors.
Great. Thanks, gents. I appreciate your time. Best wishes for another successful year in 2026. And I would be very remiss if I didn't say in closing, ad-libbing here, that the former sell-side analyst to me sat up and took note when you talked about the FET 2030. Those are legitimately impressive numbers if you even get directionally near them. So that's actually great to hear. Best wishes.
Thanks, Tim.
Thank you.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.